May 6th, 2010, 2:45 in the afternoon. On trading floors across Manhattan, something impossible was happening. Screens that had glowed green all morning suddenly bled red. Not just red, crimson. The kind of red that makes veteran traders go pale. In 14 minutes, the American stock market lost nearly $1 trillion. Not over weeks, not over days. 14 minutes. The Dow Jones plummeted almost 1,000 points. Blue chip stocks, companies that had survived wars, recessions, the Great Depression itself, were trading for pennies. Procter & Gamble, a company worth billions, dropped 37% in 4 minutes. Accenture shares fell to 1 cent. 1 cent. Phone lines screamed. Traders shouted into headsets, trying to understand what they were seeing. Was it war? Terrorism? Some catastrophic news that hadn't reached them yet? But there was no news. No bombs, no breaking scandal. Just numbers, collapsing into themselves, like a black hole had opened beneath Wall Street. And then, just as suddenly as it began, it stopped. The market bounced back. Within minutes, most of the losses recovered. It was as if the financial world had glitched, stuttered, nearly died, and then rebooted. They called it the flash crash, but that name makes it sound simple, clean, like a thunderstorm that passes and leaves everything the same. It wasn't. Because on that May afternoon, the world discovered something terrifying. The global financial system, the machinery that determines whether your pension survives, whether you keep your home, whether entire economies rise or fall, wasn't controlled by humans anymore. It was controlled by algorithms, and one of them had just gone rogue. This is the story of how we built a machine to make us rich, and how that machine nearly deleted Wall Street. This is the story of the algorithm that sold the world. To understand what happened that day, we need to go back. Back to when Wall Street was loud. In the 1980s and 90s, trading floors were human chaos. Men in colored jackets screaming, waving slips of paper, making deals with hand signals and gut instinct. It was messy, emotional, inefficient, but it was human. Then came the computers. At first, they were just tools, faster calculators, ways to process information more quickly. But gradually, quietly, they became something more. They became the traders themselves. By the early 2000s, a new breed of firm had emerged. High-frequency trading companies, HFT firms. Their offices didn't look like Wall Street. No wood paneling, no oil paintings of dead financiers. Just warehouses filled with servers, cooling systems, fiber optic cables stretching towards stock exchanges. These firms hired a different kind of person. Not MBAs from Harvard, physicists from MIT, mathematicians from Cambridge, computer scientists from Stanford, people who understood quantum mechanics and chaos theory, and could write code that thought faster than any human ever could. The premise was seductive. Remove human weakness from trading. No fear, no greed, no panic. Just pure logic, executing trades at the speed of light. These algorithms could analyze thousands of data points in microseconds. They could detect patterns invisible to human eyes. They could buy and sell millions of shares before a human trader could blink. And they could make their creators very, very rich. By 2009, high-frequency trading firms accounted for over 60% of all trading volume in the United States. Most Americans had never heard of them. But these invisible machines were making billions, skimming tiny fractions of cents from millions of trades, turning those fractions into fortunes. The exchanges loved them. All that volume meant fees, activity, liquidity. The market seemed more efficient than ever. Spreads tightened, prices moved faster. Everything was optimized. But optimization has a cost. And on May 6th, 2010, the bill came due. The day started normally. Markets were down slightly, nervous about debt problems in Europe. Greece was imploding. Investors were jittery, but nothing catastrophic. Just another day of normal market anxiety. Then, at 2:32 p.m., something happened in Chicago. A large investment firm, later identified as Waddell & Reed, wanted to sell 75,000 E-mini S&P 500 futures contracts. That's a big trade, worth about $4.1 billion, but not unprecedented. Institutional investors make trades like this regularly, Here's where the algorithm comes in. Waddell and Reed didn't have a human execute this trade. They used an automated execution algorithm. And that algorithm had a specific instruction: sell these contracts as fast as possible, matching 20% of the trading volume in the market, regardless of price or time. Think about that last part. Regardless of price. The algorithm didn't care if it was getting a good deal. It just wanted to match volume and complete the order. In a normal liquid market, this would be fine. There would be enough buyers to absorb the selling pressure. Prices might dip slightly, but nothing dramatic. But May 6th wasn't a normal day. The market was already nervous. And more importantly, the market wasn't really a market anymore. It was a network of algorithms, all talking to each other, all reacting to each other's behavior. The Waddell and Reed algorithms started dumping contracts. Fast. High-frequency trading algorithms noticed the selling pressure. They bought some of those contracts, not because they wanted to hold them, but because they could detect a pattern and profit from tiny price movements. But here's the thing about HFT algorithms. They're not investors. They don't want to hold anything for more than seconds. Their job is to flip positions as quickly as possible, making fractional profits on massive volume. So the HFT algorithms bought those contracts from Waddell and Reed, then immediately tried to sell them to someone else, to other HFT algorithms, who bought them, and tried to sell them to other HFT algorithms, who bought them, and tried to sell them back to the first HFT algorithms. It's called a hot potato effect. The same contracts being passed back and forth between machines, faster and faster. None of them actually wanting to hold the risk. And with each pass, the algorithms updated their risk models. The selling pressure was increasing. Volatility was spiking. Their programming told them, danger, exit positions, widen spreads, pull back. Within minutes, the market makers, the algorithms that provide liquidity by offering to buy and sell, started withdrawing. The bids disappeared. There was suddenly no one willing to buy. The Waddell and Reed algorithm didn't notice. It didn't care. It just kept selling, matching volume, executing its instructions with perfect, mindless obedience. Prices started to fall. First gradually, then catastrophically. The E-mini futures market crashed. And because futures are linked to stocks, the selling pressure rippled into the equity markets. Dow components started plummeting, then ETFs, then individual stocks. The algorithms noticed these price movements and responded. Some executed stop-loss orders, automatically selling when prices hit certain levels. Others pulled out entirely, withdrawing from a market that had become too dangerous, too volatile, too fast. And here's the truly frightening part. It was all happening too fast for humans to understand, let alone control. Traders stared at their screens in horror. They called their risk managers, their IT departments, the exchanges. What's happening? Is this real? Should we halt trading? But by the time humans could have meaningful conversations, form committees, make decisions, the crash was already over. The algorithms had solved the problem themselves. Some HFT firms had algorithms that detected the crash and started buying, recognizing that prices had become irrational. Market makers cautiously returned. The hot potato stopped being passed around. Prices stabilized, then recovered. 14 minutes after it began, the flash crash was over. Most prices returned to near their pre-crash levels. But for 14 minutes, the global financial system had experienced cardiac arrest, and no human hand had been on the defibrillator. In the hours after the flash crash, chaos reigned. Not in the markets. Those had recovered, eerily stable, as if nothing had happened. The chaos was in the explanations. Exchange officials didn't know what had caused it. Regulators scrambled to analyze data. Journalists called sources, hunting for a narrative. Had it been a cyber attack? A terrorist operation? Some rogue trader? The early theories were almost comforting in their human scale. A fat finger trade. Some poor trader who accidentally typed billions instead of millions. That felt understandable. Human error. Someone would be fired. Procedures would be reviewed. Problem solved. But as investigators dug deeper, the truth emerged. And it was far more unsettling than human error. This wasn't a mistake. It was an interaction. A conversation between machines that humans couldn't hear. speaking a language of pure mathematics at speeds beyond human comprehension. The market had become so complex, so automated, so fast, that it could malfunction in ways that defied traditional understanding. The official report came months later. Dry, technical, filled with charts and timelines. It identified the Waddle and Reed algorithm as the trigger. It noted how high-frequency traders had exacerbated the decline. It recommended circuit breakers, better coordination between exchanges, limits on aggressive algorithmic trading. But the report couldn't answer the deeper questions. Questions that kept regulators and traders awake at night. If this could happen once, could it happen again? What if next time the algorithms didn't recover? What if the crash lasted hours instead of minutes? What if the entire system collapsed before humans could intervene? Because here's what became clear in the aftermath. No single person had caused the flash crash. No villain. No mastermind. It was a systemic failure, an emergent property of a market that had become too complex for its own good. The algorithms weren't evil. They were following their instructions perfectly. That was the problem. But the story didn't end with regulatory reports and new circuit breakers. 5 years later, in April 2015, British authorities arrested a man in his parents' suburban home outside London. His name was Navinder Singh Sarao. He was 36 years old. He lived with his parents. He traded from a small room in their house. He'd never worked for a bank or a major trading firm. And according to US prosecutors, he had triggered the flash crash. The accusation was spoofing, an illegal trading strategy where you place large fake orders to manipulate prices. Sarao would place massive sell orders for E-mini futures, orders he never intended to execute. These orders would create the illusion of selling pressure. Other traders, both human and algorithmic, would see these orders and start selling too, worried about a market decline. Then, once prices fell, Sarao would cancel his fake sell orders and buy at the lower price. As prices recovered, he'd sell at a profit. He allegedly did this thousands of times, making millions of dollars. Prosecutors claimed that on May 6, 2010, Sarao's spoofing had been the catalyst. His fake orders had created the initial selling pressure that triggered the Waddell and Reed algorithm, which triggered the HFT algorithms, which triggered the flash crash. One man, trading from his bedroom, nearly collapsed the US stock market. When the news broke, it felt almost absurd. After all the talk of complex systems and algorithmic interactions and systemic risk, the cause was a guy in his pajamas gaming the system? But the reality was more complicated. Sarao's lawyers argued that he was a scapegoat, that high-frequency trading firms did the same thing he did, just with more lawyers and bigger computers. That the market was so fragile, so dependent on algorithmic trading, that it could be manipulated by anyone clever enough. And they had a point. Sarao was eventually sentenced to just 1 year of home confinement. The judge acknowledged that while his trading was illegal, he hadn't intended to crash the market. He was just exploiting inefficiencies, like countless other traders. The real culprit wasn't Sarao. It was the system itself. Today, more than 15 years after the flash crash, the concerns have only intensified. High-frequency trading hasn't been banned or even significantly curtailed. It's expanded, evolved. Now we're entering a new era. Artificial intelligence in trading. Not just algorithms following pre-programmed rules, but machine learning systems that adapt, learn, predict patterns. These AI trading systems analyze satellite images of parking lots to predict retail earnings. They parse CEO speech patterns for signs of confidence or nervousness. They process millions of news articles, social media posts, economic indicators, weather patterns, anything that might give them an edge. And they're fast, unimaginably fast. Some firms have built microwave networks between exchanges because light travels faster through air than through fiber optic cables. They've saved microseconds. Microseconds that translate to millions in profit. The distance between exchanges matters now. Firms pay premium rents for office space physically closer to exchange servers. They've waged a technology arms race to shave nanoseconds off execution times. All of this speed, all of this complexity, all of this optimization, and beneath it all, the same fundamental question that haunted the flash crash remains unanswered. What happens when the machines decide? Let me tell you about Sarah Chen. She's not famous. You've never heard of her. But her story matters. Sarah was a quantitative analyst at a mid-sized investment firm. Her job was to stress test the code, simulate worst-case scenarios, make sure nothing like May 6th could happen again. She found something that kept her up at night. Their trading algorithm had a built-in assumption. It assumed that in any market condition, there would always be buyers. That liquidity was essentially infinite. That you could always sell if you needed to exit a position. This assumption was embedded deep in the code. It wasn't even explicitly stated. But the flash crash proved that assumption false. For several minutes, there were no buyers. The algorithms withdrew. The market makers vanished. Liquidity evaporated. Sarah ran simulations. If their algorithm had been active, it would have experienced catastrophic losses, not because it was poorly designed, but because it was designed for a world that temporarily stopped existing. She wrote a report, recommended changes, flagged the systemic risk. Her bosses thanked her, filed the report, and did nothing, because making those changes would slow down their trading, give competitors an advantage, cost money. Sarah left the firm 6 months later. The last I heard, she was teaching high school mathematics. The algorithm she warned about is still running, still making money, still carrying the same assumption, still waiting for the next crash. Here's what haunts me about the flash crash. It's not that it happened. Complex systems fail. Technology has bugs. What haunts me is how close we came to something worse. How easily those 14 minutes could have been 14 hours. Imagine if the recovery hadn't happened. If the algorithms hadn't stabilized the market on their own. If panic had spread beyond the machines to the humans, to the institutions, to the global financial system. Bank runs, failed clearinghouses, frozen retirement accounts, economic contagion spreading across borders like a virus, all triggered by code, by math, by machines following instructions. The scariest part isn't that it could happen. It's that we've decided. It's worth the risk. We've chosen speed over safety, efficiency over resilience, profit over stability. Every day, trillions of dollars flow through markets controlled primarily by algorithms. We've built a global financial system that operates at the speed of light, too fast for humans to monitor. And we've done this because it makes money. High-frequency trading generates billions in profit. But we've crossed a threshold. We've built something we don't fully understand. Systems so complex that they exhibit emergent behavior. Markets that can malfunction in ways we can't predict. And the next time it happens, we might not be so lucky. There's a moment I keep returning to. It's from the congressional hearings after the flash crash. A senator asked an executive from a high-frequency trading firm a simple question. Can you guarantee this won't happen again? Long pause. The executive looked uncomfortable. He understood what the senator was really asking. Can you promise that the market won't collapse? That the machines won't go rogue? That the system is safe? Finally, he answered. No. I cannot make that guarantee. Honest answer. Terrible answer. Because it's the truth. No one can guarantee it won't happen again. The system is too complex. The algorithms too numerous. The interactions too unpredictable. We've built a machine we can't fully control, and we're hoping it stays friendly. It's the ultimate expression of faith in technology. We've bet our economic future on the assumption that the code is correct, the algorithms are sound, the system is resilient. But code has bugs. Algorithms have edge cases, systems fail. And when they fail at the speed of light, in ways humans can't perceive or react to, the consequences could be catastrophic. So where does this leave us? Some people argue for more regulation, stricter limits on algorithmic trading, mandatory circuit breakers, human oversight, a return to slower, more controlled markets. Others argue that's impossible, that the genie is out of the bottle, that algorithmic trading is now so fundamental to global markets that removing it would cause the very collapse we're trying to prevent, that the only way forward is through more technology, better algorithms, AI to monitor AI. Both sides have valid points, and both sides miss something crucial. This isn't really about trading, it's about control. We're living through a transition, from human systems augmented by technology to technological systems monitored by humans. The flash crash was an early symptom of that transition. A moment when we glimpsed the future and didn't like what we saw. Because the future isn't humans making decisions with computer assistants. It's computers making decisions, with humans watching helplessly from the sidelines, trying to understand what just happened. This extends beyond finance. We're building autonomous vehicles that will make life or death decisions in milliseconds. AI systems that diagnose disease, approve loans, screen job applicants, predict crime. Algorithms that determine what we see, what we read, what we believe. We're delegating more and more decisions to code, and we're doing it for the same reason we algorithmic trading, because it's faster, more efficient, more profitable. The flash crash is a warning, a preview of what happens when we build systems we don't fully understand, when we prioritize speed over wisdom, when we let machines make decisions too fast for human intervention. There's a principle in engineering called graceful degradation, the idea that systems should fail gradually, not catastrophically. That when something goes wrong, the system should degrade in a way that allows time for correction, for human intervention, for recovery. Modern financial markets don't degrade gracefully. They can fail instantly, completely, at the speed of light. One moment, everything is fine. The next moment, trillions of dollars evaporate. And the recovery, when it comes, isn't engineered by humans. It's automatic, algorithmic. The machines fix themselves, restart themselves, stabilize themselves, which is both reassuring and terrifying. Reassuring because it means the system is resilient. Terrifying because it means we're not in control. What happens the day the algorithms don't recover? What happens when the malfunction is too severe, the feedback loop's too destructive, the cascade too complete? We don't have a good answer. We just hope it doesn't happen. We hope the stress tests are sufficient, the circuit breakers are effective, the programmers didn't miss anything critical. We hope. Hope is not a strategy. I want to end with a different kind of story. Not about crashes or algorithms or trillion-dollar losses. After the flash crash, a small group of programmers, mathematicians, and concerned citizens started an organization. They called it the Financial Stability Coalition. Their mission was simple: advocate for markets that put stability ahead of speed. They didn't make headlines. They didn't have billions in funding. They were just people who looked at the flash crash and said, "This is wrong. We can do better." They pushed for transaction taxes that would slow down high-frequency trading. They advocated for transparency in algorithmic trading. They called for regular stress tests and better oversight. They tried to inject a voice of caution into a system addicted to speed. Most of their proposals went nowhere. The lobbying power of financial firms is immense. The profit motive is strong. Change is hard. But they kept working, keep working, because someone has to. And that's the paradox at the heart of this story. The system seems inevitable, unstoppable, beyond our control. But it's not. It's a human creation. Every algorithm was written by a person. Every market rule was decided by regulators. Every trading strategy was conceived by a human mind, which means it can be changed if we want to. If we decide that stability matters more than speed, that resilience matters more than efficiency, that we want markets that serve humanity, not the other way around. The flash crash gave us a warning, a glimpse of systemic fragility, a reminder that the machines we build can malfunction in ways we don't expect. The question is whether we'll listen, or whether we'll keep accelerating, keep optimizing, keep delegating decisions to algorithms that think faster than we do, until one day we wake up to find that the machines aren't serving us anymore. They're running the world, and we're just trying to keep up. 14 minutes. That's how long it took for the American stock market to nearly destroy itself, and then recover on May 6, 2010. 14 minutes that changed how we think about markets, about technology, about control. The algorithm that sold the world is still out there. It has descendants, successors, evolved versions running on faster hardware with more sophisticated code. They're trading right now, making billions of decisions every second, moving trillions of dollars across global markets. And we're trusting that they got the code right, that the assumptions hold, that the next crash will be as brief and recoverable as the last one. Maybe that trust is justified. Maybe the system is more resilient than it seems. Maybe the lessons of the flash crash have made us safer. Or maybe we're just waiting for the day when the algorithm malfunctions again. when the feedback loops spiral out of control again, when the machines talk to each other in their incomprehensible language and decide, in their mindless logic, to sell the world. And on that day, we'll discover whether we're still the masters of our creation, or whether we've become spectators in a game played at speeds we can barely measure, let alone control. The code is running. The machines are trading. The next crash is coming. The only question is whether we'll see it in time. If this story left you thinking, or unsettled, or maybe both, then share it. Talk about it. Because these conversations matter. The decisions we make about technology, about markets, about the systems we build, will define the world we live in. Subscribe, stay curious, stay skeptical, and remember that every system, no matter how complex, how fast, how seemingly inevitable, was built by humans, which means humans can change it. Before the next flash, before the algorithm sells the world.